Good afternoon. Thank you for joining us today. My name is Lauren Genuardi. I'm a financial life advisor with Telemus in the Chicago office. Philanthropy and charitable giving has always interested me, and I'm involved in several nonprofit organizations and a giving circle for that reason. Many people accomplish their philanthropy after their death in the form of bequests, but more and more individuals are choosing to give now and be more strategic with their gifts. The purpose of this webinar today is to discuss the various options in today's market and tax climate to help individuals and their families define their philanthropic goals and the legacy of their families. Joining us today, we have Paige Robinson, a charitable planning associate with Fidelity Charitable. Paige will be discussing some ways to make charitable giving more accessible and easily integrated into an overall wealth management plan. And just a quick housekeeping note before we begin, we will hold all questions until the end of the webinar. If you have any questions that you would like to ask, you can either use the raise your hand feature or type out a question in the question box. Both of those features can be found under the control panel. Thank you so much, and Paige, it's all yours.
All right, thanks, Lauren. So hi, everyone. So like Lauren mentioned, thanks so much for joining and making time for this webinar today. So as she mentioned, I am a charitable planning associate with Fidelity Charitable, and I really just love getting the opportunity to share my love of philanthropy and donor advised funds with all of you. So to get started with this webinar, as you can kind of tell, we're going to go through some charitable planning essentials and really talk about the power of the donor advised fund. There are so many ways to use donor advised funds and other charitable vehicles, but we're really going to talk through using them to maximize your deduction while also minimizing your capital gains. We're also going to get into some of the recent tax changes and common strategies we're seeing other donors use to be more strategic. We're also going to talk through some common giving trends among generations and families, and then go through some examples of how to involve your children and even grandchildren in your donor advised fund or the charitable vehicle of your choice. So finally, we'll wrap up with talking about two other types of charitable vehicles and kind of how they compare to the donor advised fund and how to decide which one of these options is best for you and your giving goals. So to start off with, I just want to kind of go over the donor advised fund and how to use it and what it is. So just the basics of it. So a donor advised fund is a program sponsored by a public charity that allows you to make an irrevocable charitable contribution, take an immediate tax deduction, and then recommend grants to charities over time. So this really means that you can front load your giving and maximize your tax deduction while still deciding which charities to recommend gifts to. So one of the benefits of the donor advised fund that we commonly hear people are most interested in is the ability to invest the funds while you're deciding where to give to. So not only does this help you maximize your charitable giving as the investments grow, but they also grow tax-free until a grant recommendation is made. So as you can see kind of from the info, you as the individual makes the tax-deductible donation to the DAF, and then from there are able to grant to multiple charities. Another big benefit of using the donor advised fund to be more strategic is because you are making one tax-deductible donation to the donor advised fund, you are getting an immediate tax deduction. So you're getting one tax receipt, whether you give to 3 charities or 40 charities in the end, you're still going to have that one tax deduction, which a lot of people think is so much simpler than keeping your typical shoebox full of receipts or file folder. You just get the one, and I'm sure your accountant will really be happy about that as well. So I do want to note that when you make a donation to a donor advised fund, you do technically cede control of the assets, which essentially means that Fidelity Charitable has final say over whether the grant is approved or not. So really the only time the grant is going to not be approved is if the organization, for example, is no longer in good standing with the IRS, or the special purpose designated on the grant gives you some sort of benefit in return. So think tickets or auction items. Those are examples of grants that would not be able to be made through the donor advised fund. But overall, we really want you to think of these accounts as charitable checking accounts. So kind of just a quick story about how I use my donor advised fund. We get questions all the time about sponsoring someone in a race or a walk. Those are becoming more and more popular these days. So I actually used my donor advised fund this year to sponsor my partner, Jim. He was riding in a bike ride for cancer research, and I made a grant to the END organization and just made a note of his rider ID and his name. And they actually credited the funds to his fundraising goal. So I saw it on his fundraising page. It took about a week or so, but I think it's so much easier because I had donated appreciated securities to the account, and then the organization just got a check. So again, that's kind of the basics of the donor advised fund. Really a good candidate for these types of accounts is anyone who wants a turnkey solution that combines kind of low cost, potentially tax-free growth with the flexibility to support your favorite charities at any time. Perfect. And then the next one. Perfect. So just talking about some assets to fund your philanthropy, some smarter assets. So why is it important? So while cash and checkbook giving are some of the easiest ways donors give, many people I've spoken with say that they don't realize there are alternatives that can help them do more for themselves as well as others. So cash, as we like to say here at Fidelity Charitable, is the most expensive asset to give. There are other strategies that can really help you get a bigger bang for your buck. So donor advised funds accept a variety of assets in addition to cash. These include appreciated securities. This can be publicly traded stock, bonds, mutual funds, sometimes even life insurance. And then there are the more complex assets, as we refer to them as. So these are going to be non-publicly traded securities, such as private or restricted company stock and even real estate. So what makes these assets so appealing is that typically you're entitled to the full fair market value tax deduction at the time that you give the gift. Giving these types of assets also helps you eliminate capital gains. And then, of course, the last one is because of the tax savings of not paying capital gains, you're actually able to give as much as 20% more to charities that you support rather than if you had sold the assets and donated the cash after the fact. So talking about the Tax Cuts and Jobs Act, so I know diving into the tax code can get complicated very quickly, but I just wanted to give kind of a high-level overview of some of the changes that the Tax Cuts and Jobs Act have kind of put into place for charitable giving. So just as a quick overview, the new tax law maintains 7 tax brackets, but kind of tweaks the income thresholds and lowers rates for most brackets. Second is the carry forward rules were maintained, which allows donors who contribute more than their threshold to carry forward the excess part of their gift for the next 5 years. The third one, and this is the big one for charitable giving, is the standard deduction was nearly doubled for both single and married filing jointly. Next one is going to be just increased adjusted gross income limitations for cash contributions. So those were actually upped from 50% of your adjusted gross income to 60%. And then the last one is really doesn't come into effect as often, but basically they did away with something called the P's limitation, which basically reduced the value of the taxpayer's deductions over a certain threshold. So that's been removed completely. But if you remember anything from this slide, the big one is going to be the increasing of the standard deduction. That's really been the one that we've been seeing most donors have a problem with. A lot of them are saying that they no longer are able to itemize because they fall below this 12,200 or the 24,400. So this is one that we're coming in contact with quite frequently. So let's take a closer look at some of just the tax basics when it comes to income tax. Again, don't want to dive too deep, but I think it's helpful to have this in the back of your mind whenever you're thinking about giving to charities or what type of vehicle is right for you. So although charitable contributions are 100% tax deductible, there are limits as to what you can deduct based on your adjusted gross income. So on the cash side of the house, you can deduct up to 60% of your adjusted gross income. Again, this used to be 50%, but was changed to 60. Whereas if you decide to do a private foundation, which we'll talk about a little later, you're able to deduct 30%. So those are, 60% for public charities, which a donor advised fund does qualify as, and 30% for private foundations. So if you go the route of giving appreciated securities, which again is usually kind of the better option if you do have these highly appreciated assets, 30% limit for giving to public charities versus 20% if you give to private foundations. So again, if you don't remember anything else, this is an important one, that you're able to deduct 60% of your adjusted gross income for cash contributions and 30% for security contributions to donor advised funds or public charities. And then, like I said, the deductions, the itemized deductions may not be as valuable for you now since the standard was doubled. So one strategy I just wanted to give an overview that we're seeing a lot of people have success with is what we're calling bunching. So bunching essentially is where you take 2 or 3 years worth of giving and actually put it all into a donor advised fund in 1 year. So for example, if you're giving $10,000 to your church or a local organization every year, we're recommending that you decide to bunch those charitable contributions. So that means putting $30,000 in the account this year so that you're able to get above that standard deduction limit, and then still kind of doling out those $10,000 increments to the charities for the next 3 years. So that allows you to take the benefit of itemizing this year, and then you can just take the standard deduction the other 2 years while the charity is still receiving the same amount of funds. Again, this is a pretty popular tax strategy that we're seeing with people, and we actually have a video on our website that I'm glad to send the link out afterwards, but it kind of gives an overview of this strategy and how you can best use it. As always, we want you to work with your accountant and your advisors to make sure that this is right for you, but this is a way that we're seeing a lot of people get above that standard deduction limit, and we want you to be able to take advantage of your charitable contributions. And this is a great way to do that. So kind of as you can see by this graph, we're really getting the word out about donating appreciated securities. So last year, Fidelity Charitable, 63% of all of our contributions were non-cash assets. So that's 47% publicly traded securities, and then the 16% of those non-publicly traded assets. So think your more complex assets. That's if you're selling your business, or sometimes some real estate as well is in there. So I think we're getting the word out about the appreciated assets and how important it is to think of those over cash. I really think that this number will continue to get larger as more people are informed on the power of non-cash assets. But I think this is a cool number to keep in mind. So now I'm just going to show you kind of a brief example of donating stock to reduce taxes and increase the giving overall. I know it's a lot of numbers, so hang with me, but in this example, let's assume that you are a married couple filing jointly with an adjusted gross income of $500,000. So you actually have some securities with long-term unrealized gains of about $30,000. So if you were to sell these and actually give cash to a donor advised fund or a charity after the fact, you're subject to the highest federal tax bracket, which would be for capital gains would be about 23.8%. So essentially it's saying that if you donated the cash proceeds, you would be able to give the charity or take the deduction as well as $42,860. Which still is great. You know, you're saving $15,000 and some change, but the charity is only getting the $42,860. Now, if you were to donate those directly to a charity or a donor advised fund, you don't pay any capital gains because we liquidate them on your behalf. And then the charitable deduction, you're able to actually take the fair market value, which is the $50,000. So not only are you able to save more on your taxes at about $18,500, but there's also over $7,000 more dollars going to charities of your choice. And we hear this all the time with people that we are talking to, is they say, hey, I sold the securities, I want to give the cash now. And that kind of always makes us cringe. We want to make sure that if you do have appreciated assets, you are thinking about giving those in kind versus giving the cash after the fact. So that's a great strategy to maximize your giving as well as your deduction. And now we're going to kind of dive into, now that we've talked about assets that you can give and ways to maximize your deduction, one thing that I think is really important in philanthropy is involving your family, whether that be your children or your grandchildren. This is a great tool, using the donor advised fund, to really get them involved in charitable giving. So giving across the generations, I just think this is great information to have. Essentially what we're saying here is that every generation thinks of giving differently. I won't go through all of these, you can read them, but for matures, they have loyalty to organizations and respect for hierarchy and authority. The kind of the boomer stage, they love grassroots causes and organizations, and they want to share their experience with philanthropy with the next generation, which is perfect for these types of accounts. Generation X, as you can see, leans towards smaller organizations, and this is the generation that really likes to volunteer as well. So I think knowing where your family members fall in these categories is very helpful, because if you have someone that kind of falls in the Generation X category, maybe you want them to donate more money, but they prefer to volunteer. I think it's important to know what everyone's philanthropic goals are, so that when you talk about it with the family, you're able to include everyone's ideas and opinions. And then lastly, millennials, they want to see a direct impact, and they also want accountability and transparency with the organization. So a lot of times we see with millennials that are giving to us, they want to research their organization, find out where their money is going to, if it's being used correctly, if it's being used in a way they deem appropriate. So again, these are just things to keep in mind when you're talking to other family members, so that you can make sure that everyone's ideas on philanthropy and charitable giving are included. And this kind of continues that, but it's just showing the percentage that give versus the charities supported. So it makes sense that matures are giving the most. Typically they're at the highest tax bracket, so they're able to give more money to charities. So they're typically supporting about 6.2 charities, versus millennials kind of on the lower end are doing 3.3. But again, sometimes the millennials and the Generation X prefer to volunteer. So maybe they are giving of their funds in a different way. So they're giving their time instead of actually giving. And that kind of brings us to some interesting ways to use your donor advised fund. So the Gift for Giving is one of my favorite programs that we have here at Fidelity Charitable. So the Gift for Giving actually allows account holders to give funds to their family members or to family friends. It's kind of similar to a gift certificate, and that you're able to set aside, $100 and give it to your grandchild, and then your grandchild gets to actually recommend a grant to a charity of their choice. So I actually have a family that I work with who uses this in such an interesting way. So they, every year, the grandparents will actually recommend Gift for Givings to all of their grandchildren. They give them all, I think it's $200, $300, but that's their money to give away to charities. And what they want them to do is they want them to research the charity, find out why they want to give to them, and then at Thanksgiving, they all sit down and they decide if the charity they chose is kind of the one they want to give their Gift for Giving to. And I just think that's so fun. They're, sitting around the table at Thanksgiving, and it's a perfect intro to talk about philanthropy, is to ask, hey, I know I gave you $100, $200 to give. Where did you decide to give those funds? And that same family, I think they had tried to include their grandson for the first time. He was the youngest. And I think at the dinner table, he said he wanted to give his Gift for Giving to Tom Brady. And so, of course, that's the conversation they had to have about, hey, he's great. He's not a charity. So let's talk about what a charity is and why it's important to give. So gift for giving is just such an easy way to bring this up with family members. Again, there's so many interesting ways to use it. You can even do it for teachers. If you're doing teacher gifts, you can say, hey, I actually sent you an email with some funds that you can recommend to charities. Maybe they want to do educational causes. So there's just so many ways that this gift for giving can actually be used. So not only can you give to charities of your choice, but you can also set aside anywhere from $50,000 to $5,000 for someone else to recommend funds to charities as well. And that kind of leads us to kind of some after the fact for the donor advised fund. So we actually have a couple different successor options where you can involve your family. So you can actually name your children as successors on your giving account. So they would actually take over the account after you pass away, and the account would live on. So they could add their own money to it. They could then add their own children on the account. Really, it can go on into perpetuity. So it's a great way to do some legacy planning for yourself and your family so that they can also be involved in charitable giving. Another successor option that we have here, if you don't want to do your children or just have one charity get a lump sum, what we have here, and I think it's pretty interesting, is the endowed giving program. So through this option, you're actually able to build a lasting legacy. We actually send out the grants on your behalf, so the account would remain the same, and we would actually send out the funds automatically every year based on a percentage of your account that you tell us to. Usually it's going to be 6 organizations or less. So you would tell us, hey, I want to send 6% to these 6 charities. Let's do 1% each. And we actually just send the grants out for you automatically every year. And then you'll choose that name for the giving account. So this is how it will appear to the end recipients. So we'll be sending it to them saying, hey, this is coming from the Robinson Family Legacy Fund. And it's just a great way for charities to still receive the funds that they have been accustomed to from your family, even after you're gone. So we really love this for legacy planning. And a lot of people really love that they can kind of know that their funds are going where they want them to, because they choose the 6 charities. We keep sending the funds out every time. And this can also be used in addition to your other successor options. So you don't have to do one or the other. A part of your account can be in the endowed giving program, and the other part can go to your children still. So you can use a combination of these options to involve family and also build a legacy, which we think is really important. And then next we're going to talk through some common giving strategies and vehicles. So of course, as we talk through, there's kind of 2 different options. So there's giving while living, and then giving and generating some income as well. So depending on your goals, these are some great options. So we're going to talk through private foundations and charitable remainder trusts. I'll touch on charitable lead trusts as well. We just don't see those as much in the industry. I would definitely say that right now, donor advised funds, private foundations, and charitable remainder trusts are definitely the top 3 vehicles that we talk about on a daily basis. So again, as we said with donor advised funds, it's an immediate tax deduction. The funds are irrevocable, and they do have to go to 100% tax deductible organizations. So the private foundation is a little different. So the private foundation, as you can see, is a separate tax entity, and basically it's established as a nonprofit or a trust. So it's typically through a substantial initial gift and must be organized or operated exclusively for charitable purposes, although there's a little more flexibility in these as to where you can give your funds. So with a donor advised fund, you have to give to 100% tax deductible donations. With a private foundation, you have a little more flexibility in that you can hire people to run the private foundation and pay them out of it. You also may be able to do some kind of more intricate giving strategies. Maybe you want to fly somewhere to actually volunteer. You can pay for that typically out of a private foundation, whereas with the donor advised fund, it's just straight donations. So I think what's on the rise more and more in the industry is using several of these vehicles. So we have a lot of people who have a private foundation, but also use a donor advised fund. The reason for that is with a private foundation, you do have to file what's called a 990 every year. That tells exactly where you've given your funds. It lists every charity that you've given to. And then also there is a 5% distribution requirement for private foundations every year. So the donor advised fund does not have that. You're able to give whatever you see fit. And then on top of that, you can do anonymous granting through the donor advised fund. Whereas again, with the private foundation, because you are filing a 990, nothing that you actually give is private, which is funny because it is a private foundation, but the places that you give to are not private. They are listed on the 990. So we do have a lot of people who don't want organizations to know they are giving to them. They don't want to be solicited. They just want to give the funds. They will actually put some funds from their private foundation into a donor advised fund and kind of use the donor advised fund to give anonymous grants to charities. So that's a way that they work together. So really a good candidate for this type of vehicle is going to be a very high net worth client who is interested in operating their own organization. They also will be able to manage the investments. And then, like I said, they may be able to sponsor charitable events and hire a staff as well. So those are kind of the main differences. And then also, as we mentioned earlier, the tax deductions are different. So for cash contributions, you're limited to 30% of your adjusted gross income. And for security contributions, you're limited to 20% with a private foundation versus 60% for cash and 30% for securities with a donor advised fund. So those are two main differences. Okay, so next we have the charitable remainder trust. So the charitable remainder trust actually generates an income stream for clients and their beneficiaries, with the remainder portion going to charities. So it's different in a donor advised fund in that the charities are not getting the funds right away. The charitable remainder trust is actually distributing income to individuals or one individual, and then after they pass away, the funds are then distributed to charities. So it's still an irrevocable transfer of cash or property, but it's not as great of a deduction because there is some income coming out of it. So kind of two things to remember about charitable remainder trusts is there's two different types. One is going to be a charitable remainder annuity trust, which actually distributes a fixed annuity each year to an individual or multiple individuals. And then the second type is going to be the charitable remainder unit trust, which distributes a fixed percentage based on the balance of the trust assets. So those are the two different types of charitable remainder trusts. Again, at Fidelity Charitable, we just offer the donor advised fund, but we do get questions on this quite frequently. They want an income stream, which a donor advised fund can't provide. So a lot of times we will refer them to work with their advisor or an attorney to set up a charitable remainder trust, especially if they need that stream of income. So again, who's a good candidate for this is really going to be clients who want an immediate charitable deduction, but also have a need for some sort of income stream for themselves or another person. And you can actually involve your family as well, because of course the family can be the individuals that receive the funds, with the remainder going to charities of their choosing. So just to kind of recap those three that we talked about, the donor advised fund is an immediate deduction, kind of a higher tax benefit. The private foundation is a lower tax benefit, but more control over where you can actually give grants to and what you can use the funds in a private foundation for. And then a charitable remainder trust is really going to be a great vehicle if you're looking for income. So those are the three main ones that we see. Like I said, just to touch on the charitable lead trust, it's essentially the polar opposite of the charitable remainder trust. So a sum of that money goes to the charity to begin with, and then individuals receive payouts after the fact. So again, just flip the charitable remainder trust on its side, and that is essentially a charitable lead trust. I don't hear as much about those, although I'm sure some people still find them very helpful. The three main ones are definitely going to be the charitable remainder trust, the private foundation, and the donor advised fund. And then I know we're wrapping up kind of a little early, but that'll give us some time for questions if anyone has it. So again, the donor advised fund really just provides a way to involve your family in your giving while also using some tax strategies that we talked about. The bunching strategy, where you actually bunch multiple years of charitable giving into 1 year so that you can get that immediate tax deduction. And then involving your families either using the gift for giving or our multiple successor options. And then, of course, I didn't mention, but you can always add your children as account holders as well. So that allows them to work with you with the donor advised fund and recommend grants at the same time. So that's always a fun option as well. If we have a family that's very interested in giving, everyone wants to give now, we can do an account where everyone's on it. So that's an option as well. So again, like I said, I know we finished kind of a little earlier, but I'd love to open it up for questions if anyone can think of any. I know we've gone over a lot today, but open to anything.
Thank you so much, Paige. Yes, we have 2 questions. One, can a donor advised fund or a charitable remainder trust be the direct recipient of RMDs via qualified charitable distribution?
That's a great question. So donor advised funds were actually specifically excluded from the legislation for qualified charitable distribution, so we cannot receive them. I don't know for charitable remainder trust, but I'm assuming that that is the same because you can actually receive income from that. So I don't think those can be used either. It does have to be direct charities.
Great. And then one more. How do donors typically organize their families, friends that can recommend grants using the gift for giving program? Do most require unanimous agreement on grants by all participants, or do some allow each children or friend a choice to pursue causes important to them?
Yes, so the way that it would work is when you recommend, so let's say that you set aside $100 for your grandchild to do a gift for giving. They recommend the grant from their own portal, I guess we'll say. So they'll have a login that they can go into and actually recommend the grant. So they'll be able to access our database of organizations to use. There's not really a research function built into there. That is great feedback. I'd love if that could be incorporated. So what will happen is they will actually be able to research the charity outside of the gift for giving. Would that be using like iStar or Navigator? They can research it outside of there and then recommend the grant through the portal that we use. When they do recommend the grant to the charity, it is anonymous in the fact that the person that gave them the gift for giving won't be notified of where they're giving to. So that's why I said it is kind of on them to get together if they are curious and say, hey, I just want to know, like, what charity did you end up supporting with your gift for giving that I gave? Because from their account, it'll just show that they gave a gift for giving. It won't show where it actually went. Does that answer the question? Sorry, I feel like that was a long-winded way of.
That was great. That's all the questions we have. I want to give a big thank you to both Paige and Lauren for the webinar today. And we will have a on-demand version in case you want to reference it in the future. So thank you again, and we'll hopefully see everyone in our next webinar.
Awesome. Thanks for having me, guys.